Good evening to everyone. I'm Domenico Lombardi, Director of the Global Economy Program at CIGI, and I want to give you a warm welcome to tonight's lecture on the case for divesting from fossil fuels in Canada. And there are at least three good reasons why the divestment from fossil fuels is important for Canada. To start with, Canada is one of the largest emitters in the world of greenhouse gas per unit of output. Canadian investors and lending institutions are particularly exposed to the fossil fuel industry. And third, most recently, the COP21 agreement, the so-called Paris Agreement, to limit the average temperature increase threatens to marginalize much of Canada's carbon reserves and points to a significant downsizing of oil sands operations in the near future. So these are all issues that rank very high in our agenda here at CIGI, and we are particularly delighted to discuss these issues and have Jeff Rubin to speak about these issues tonight at this event jointly organized with Divest Waterloo. And let me acknowledge Laura Hamilton and Nicole Langlois for helping us to co-organize this event. Let me now turn to our speaker. Jeff Rubin is a colleague, he's a CIGI Senior Fellow. He's also one of the most sought-after energy experts. His first book, which he wrote in 2009, Why Your World is About to Get a Whole Lot Smaller, was a bestseller, was the #1 selling nonfiction book in Canada, in the whole of Canada, and won the National Business Book Award. And then Jeff authored another couple of books which were bestsellers in their own right. Jeff, prior to becoming an author, prior to joining CIGI as a senior fellow, was chief economist for CIBC World Markets. And he now has a widely followed blog that is carried on both the Globe and Mail and the Huffington Post websites. Following Jeff's lecture, another CIGI colleague of mine, Jason Thwistlewaite, will provide comments and will moderate the ensuing Q&A. And Jason is, besides being a CIGI fellow, he's an assistant professor in the School of Environment, Enterprise and Development at the University of Waterloo. And many of you are familiar with his research, which focuses on the implications of the new environmental and climate change risk disclosure regime on the financial sector, and on how to align policy and industry's resources to mitigate climate change. So without any further ado, Jeff, I'll call you to the podium for your lecture. And then after your lecture, then Jason will also come to the podium and will, as I said, we'll have a brief conversation with you and then moderate the Q&A. And we'll be gathering questions from the audience, of course, but also through our social media. Thank you very much.
Thank you very much, Domenico, and welcome everyone. You know, the world of socially responsible investment has a long history that I guess dates back to the early days of the Quakers in the 18th century, which forbade its membership to invest in the slave trade. Since then, of course, it's broadened considerably. Many of you will probably recognize the divestment campaign that was launched against the apartheid regime in South Africa. Divestment campaigns have been targeted against the munitions industry, the alcohol industry, the tobacco industry. More recently, the scope or the criteria for divestment has included such issues as corporate governance, racial and gender equality, environmental record, independence of directors. But certainly in the last 4 to 5 years, the most dynamic and fastest growing divestment campaign in history has been the worldwide movement to divest from fossil fuels. Now, like most divestment campaigns, the movement to divest from fossil fuels started off essentially based on moral grounds, that we should not be financing economic activity that is responsible for anthropogenically induced climate change that could have catastrophic consequences for the environment and indeed human civilization. And of course, the early adherents or the pioneers of the divestment campaign from fossil fuels were NGOs, religious institutions like the Anglican Church and the United Church, as well as some university endowment funds, most notably Stanford University. More recently, however, the divestment campaign has crossed over into the mainstream financial community. And with it, so too has the focus shifted from one of social activism to really a fiduciary responsibility to protect clients' funds from the consequences not only of climate change, but maybe even more importantly, from the consequences of actions that countries around the world might take to mitigate that climate change. Many institutional funds, like for example, CalPERS, the California State Employee Retirement Fund, and the largest pension fund in North America, have recognized that increasing efforts to mitigate global climate change is going to have profound consequences on our use of fossil fuels. Moreover, they've recognized that the time frame for action, which once used to be thought of as in the medium or long term, is pressingly urgent. Even the old target of holding global temperature to no more than a 2% Celsius increase and capping atmospheric carbon at the 450 parts per million threshold implied that we could no longer continue business as usual combustion of oil, natural gas, and coal, that the world's remaining carbon budget, so to speak, only allowed for possibly less than 2 decades of fuel consumption at current rates. Tonight, I'm going to talk about what that implies about fossil fuel consumption in the fossil fuel industry, focusing, since this is a Canadian audience here, on what Canada's largest fossil fuel resource is, which is the oil sands, and also what has received a tremendous amount of investment in this country. Now, what I'm saying about the oil sands, though, would be equally valid for all high-cost sources of fossil fuel, whether they be oil, bitumen, natural gas, or coal. I mean, while the oil sands have often been targeted by environmental groups, owing to both its larger emission trail and otherwise large environmental footprint, it's not really environmental protests that is the sector's real nemesis. The sector's real nemesis is today's oil prices, because as one of the highest cost sources of oil in the world, probably next only to Arctic production, it has been challenged by world prices that are about half the cost of new oil sand production. I say world oil prices, but in point of fact, oil sand producers don't get anywhere close to world oil prices, Brent or West Texas Intermediate. They instead get a heavily discounted price for their product called Western Canadian Select, which trades at anywhere from 20 to 25% below world oil prices. If you listen to the oil sands industry right now that is contending with not only investor divestment, but also the exit of a number of multinationals, they will have you believe that their problems stem from two general areas. One, a deliberate attempt by OPEC to squeeze them out of the market through overproduction, and two, the desperate need for tidewater access, pipelines that would take their fuel to tidewater and allow it to be shipped to foreign overseas markets in both the Pacific and Atlantic basin. I'm going to deconstruct both of those arguments, beginning first with the OPEC argument. It is certainly true that before OPEC's announced cutbacks, the cartel was producing more than it ever was before, over about 33 million barrels a day. But what the cartel produces is not what impacts world oil prices. Its impact on world oil prices is what it sells to the rest of the world. And there's a huge distinction between OPEC production and OPEC exports to the rest of the world. While OPEC produces roughly 50% more than it did at the time of the 1973 and 1979 OPEC oil shocks, it actually exports about 250,000 barrels a day less than it did 45 years ago. All of the increase in OPEC production, which about 50%, has been cannibalized by its own voracious appetite for oil. In fact, oil demand in OPEC countries has grown at a multiple of growth rates anywhere else in the world. A country like Saudi Arabia, for example, would consume over 3.5 million barrels a day, almost twice the consumption of Canada. It would combust over 1 million barrels a day simply to power desalination plants. And of course, if you look at why has oil consumption grown so rapidly in OPEC, the reason is that the prices people pay for oil in OPEC are a fraction of what they pay elsewhere. So what has created this supply glut that has seen oil prices crash from over $100 a barrel in early 2014 to levels that are half that? Well, ironically, the glut comes not from OPEC, it comes right here in North America. It comes from the extra heavy oil production from oil sands, and most importantly, from the 4 to 5 million barrels of light oil that is now produced by U.S. shale formations. So much has that changed the equation in the United States that it rescinded the ban on exporting crude that had been in place since 1974. The increase in shale production has not only reduced U.S. oil imports, but it's also allowed the U.S. to ship that oil to other places in world markets, adding to today's glut. Well, the second point that they would talk about is the desperate need for tidewater access. And of course, they would tell you that Western Canadian Select, which is the price that they get for their bitumen, trades at that big discount to oil prices, and that's cost billions and billions of dollars. What they don't tell you is they don't produce oil. They produce bitumen. Bitumen is not oil. To turn bitumen into oil, it first has to be upgraded. And then, only then, can it be refined into products like gasoline, jet fuel, and diesel. Nowhere in the world does bitumen trade anywhere close to oil prices. And in point of fact, the U.S. market, which is the sole market for Canadian bitumen right now, turns out that it pays the highest prices for bitumen anywhere in the world. And that's because the bulk of heavy oil refinery capacity is in the US Gulf Coast, where it's not only supplied by Alberta oil sand, but by heavy oil from Mexico, heavy oil from Colombia, and heavy oil from California, the clean state's dirty little secret. If we look at how other heavy oil crudes trade, like Mexico Maya, it in fact in Asia trades for over $8 a barrel less than it gets from Gulf refineries. In Europe, it trades for over $3 a barrel less. So these pipelines, for example, Kinder Morgan's twinning of the Trans Mountain pipeline that would allow for another 500,000 barrels to be shipped out to Asia, or TransCanada's Energy East pipeline that would take bitumen across the country for shipment to Europe, would not unlock higher prices. They would result in even lower prices than the prices currently oil sand producers are getting in the US market, Western Canadian Select, which is about half the price of their current production. So, where does that leave the industry? Well, what's happening is not just divestment from, things like the Norwegian Sovereign Wealth Fund or CalPERS or Stanford's Endowment Fund, but more fundamentally what's happening is divestment in the industry itself. That we have seen in the last 3 years a growing exodus of multinational players, many who have been in this sector for over a decade, that are leaving the sector. Not because of fears of global emissions, simply because under today's economics, the oil sands don't make a whole lot of sense. It started out in 2014. It started with the Jocelyn mine. Total SA, the huge French oil giant, walked away from the $11 billion Jocelyn mine along with its partners Suncor and Canadian Occidental, because as oil prices started to plunge, that mine didn't make any sense. Shell then later walked away from the Pierre River mine that was going to produce about 200,000 barrels a day. Some stayed hoping that prices would recover. Western Canadian Select got as low as $13 a barrel by early 2015. We've seen, however, that the cutbacks in OPEC oil production have not led to the kind of price recovery that oil sand producers were hoping for. That basically what's happened is that we've substituted OPEC production for shale production in the US, which has effectively shut out the oil sand producers. So we've seen increasingly more leave. We've just seen Shell an $8.4 billion sale of its share in the Athabasca oil sands to Canadian Natural Resources. We've seen ConocoPhillips announce that they're pulling out. BP has just announced that it's going to be divesting of its 50% share with Husky in the Sunrise project. We've also seen a number of other divestments, Marathon selling its 5% share in the Syncrude project, and Chevron also announcing that it is abandoning the sector. In most cases, we're seeing these companies use the money that they raise from selling their oil sand assets and instead investing in shale formations like the Permian Basin in Texas, which have much, much lower costs and therefore much more attractive break-evens with today's prices. I guess it's somewhat ironic that as we're seeing a mass exodus of multinationals from the oil sands sector, some like Shell who have almost been there from the beginning, while that is happening, we've just seen approval for 2 major pipelines. Approvals on both sides of the border. We've seen the Trudeau government approve the Kinder Morgan twinning of their pipeline that would take undiluted bitumen to Burnaby, a port just outside of Vancouver, for shipment to these Pacific markets. And we've seen, of course, Donald Trump reverse Obama's decision and give the green light to Keystone XL. Let me point out that there's a big difference between regulatory approval and economic viability. It's true that without regulatory approval, we never even get to the question of discussing economic viability. But regulatory approval and economic viability are two different things. And I think we're discovering that just recently. TransCanada Pipeline acknowledged that they were having difficulty obtaining the shipper agreements that are needed for Keystone XL. Shipper agreements are long-term supply contracts. Before pipelines can get financed and built, they have to demonstrate to the market that, in fact, they have suppliers. And in fact, TransCanada is finding it's very difficult to get those long-run supply contracts because instead of ramping up another 800,000 barrels a day of production, we're seeing more and more players leaving that sector. And it will be interesting to see if Kinder Morgan can also line up the shippers' agreements that would supply the Trans Mountain pipeline, although changes in BC election may also change the regulatory approval there as well. Well, to be fair, if I was here talking to you on behalf of Suncor or TransCanada Pipeline or Enbridge or Kinder Morgan, I'd go, well, Jeff's right. Today, it doesn't make sense. But pipelines and the new oil sand projects that would supply these pipelines are, long-term projects with economic lifetimes of 30 to 40 years. So just because today at a particular juncture in time, oil prices don't justify this production, they will, in the fullness of time, just look back at the last 30 to 40 years. Business as usual growth in world oil demand will eventually, push prices back to where these projects make sense. And that leads us to whether investors can buy that argument. Can investors buy that there's going to be business as usual, inevitable growth in world oil demand that will ultimately skate even the most costly sources of oil and other fossil fuels on side? If we look at the commitments that Canada and other countries signed at COP21 for a temperature target of holding global average temperatures to 1.5 degrees, if we look at what that implies about world fossil fuel consumption, and in particular world oil consumption, then depending on the degree of probability that we want to attach to the outcome, it implies that anywhere from 25 to 50% of world oil consumption will have to be cut over the next 20 to 30 years. World oil consumption's right now about 96, 97 million barrels a day. And even more to the point, virtually under any scenario, it implies that world oil consumption would likely have to peak within the next decade, possibly even less. What future then does that imply for one of the highest cost sources of oil in the world? Even if we were talking about proportional cuts, it would mean that oil sand production right now, 2.8 million barrels a day, would be cut to something to the tune of between 1.5 to 2 million barrels a day. But we're not talking about proportional cuts. We're talking about disproportional cuts because the oil sands, along with Arctic oil, is the marginal supplier. It's the high-cost producer. It would bear a disproportional amount of the reductions in world oil consumption. Far from filling new pipelines, the throughput there wouldn't even fill existing pipelines, which are likely to become stranded assets. What future then does the oil sands have in that kind of world? A very uncertain one. If it has any future, it's along very different business lines than the business lines it has operated on since its inception. And that has been to basically dig out as much as you can and to sell the raw material in its unprocessed state. 90% of the bitumen that we export to the United States is not even upgraded into oil, let alone refined into gasoline or diesel or petrochemicals. So that's not going to work. Obviously, we're not going to be able to double production. I mean, the time frames in which the oil sand industry said that they were going to double production are precisely the same time frames that the rest of the world has committed to very significant emission reduction and implicitly reduction in consumption of fossil fuels, particularly oil. The challenge will be to do more and dig up less. And when I say do more, to process and upgrade the resource instead of always concentrating on extracting more. Now, there is a reason why 90% of the bitumen that we pipe to the United States is not upgraded, because many of the players, multinationals, already have upgrading and heavy oil refining capacity in the Gulf Coast. It's redundant to build it here. It's much easier to mix the unrefined, unupgraded bitumen with enough diluent to ship it to a pipeline to an upgrader or refinery that already exists. It will be interesting to see with the change in ownership, because you notice that when these multinationals are leaving, whether they're Chevron, whether they're Shell, they're leaving and they're essentially selling it to Canadian firms. It will be interesting to see whether firms like Cenovus and Canadian Natural Resources and Suncor adopt a different model. But indeed, if we look at the difference between Western Canadian Select, which is the price of raw bitumen, and the price of gasoline and home heating fuel and diesel, there's a tremendous amount of value added yet to be captured. In other words, this is an industry that could generate a lot more economic value added and produce less. Whether it does so or not remains to be seen. It's almost certain that this is an industry that's going to be significantly downsized. And that raises, of course, the last issue of environmental liabilities here. What are the environmental liabilities that we really face when we talk about the oil sands? And of course, traditionally we have focused on emission trail, and for very good reason. This is the single largest source of industrial pollution in the country. And indeed, as had been pointed out by environmental groups during the election, that the planned increase in oil sand production, if it ever occurred, would very seriously jeopardize the country's ability to meet its pledged emission targets, which is a reduction in national emissions by 2030, 30% below 2005 levels. I mean, that would be nothing new. Canada has never met its previous emission targets under either the Chrétien or Harper government, but I think there's an expectation that the bar is supposedly raised with the Trudeau administration. I'm just saying that it would be virtually impossible to meet those emission reduction standards with a doubling in oil sand production. The good news is that the doubling in oil sand production is not going to happen. Even better news is production is going to decline. And when production declines, guess what? Emissions decline too. But while there's going to be a fainter carbon trail in the sky, there's going to be a lot heavier footprint on the ground. There is already an archipelago of over 200 square miles of toxic tailing ponds that are the byproducts of oil sand operations that litter across the boreal forest of northern Alberta. Oil sand producers are supposed to pay into a provincially administered fund that would ultimately pay for the reclamation of these sites. But as the Auditor General in Alberta has already pointed out, that reclamation fund is woefully underfinanced. Oil companies will say, hey, we're going to be here for the next 30, 40 years. We'll pay into that fund. And besides which, right now, our ability to do so is impaired by low oil prices. But it's precisely a time of low oil prices that the liabilities are the greatest. If oil was triple-digit levels, the participants would have the cash flow to fund those reclamations. But if we're instead going to see this industry shut down production, if we're going to see instead bankruptcies like we've seen in the US coal industry, then unfortunately I think that these liabilities are ultimately going to be picked up by the Alberta taxpayer if they're not absorbed by shareholders of oil sand companies. And therein lies an environmental cleanup, the cost of which Canada's mining industry has never seen. And believe me, Canada's mining industry has left many an environmental mess, like, for example, the giant mine in Yellowknife. So I think our thinking about the environmental damage from the oil sands is going to shift. We quite rightfully focused on emissions in an ever-expanding industry. I think the real concern is going to be the reclamation of tailing ponds that may well be abandoned as production is shut in. So I think I've, outlined some of the reasons why there's a compelling case to divest from the sector. I think there's a compelling case to divest from the sector right now, given the unfavorable economics. But if you believe at all that the world is going to come anywhere close to meeting its emission reduction targets, then that's really a fatal outlook for such a high-cost resource in an oil industry that would be significantly contracting. So, why then haven't we seen more divestment? Well, that's a very interesting question. So let's just talk about what are some of the practical concerns. And let me first talk about the institutions, who are the largest investors. By that I mean pension plans, large insurance companies. Most large institutional funds are measured how they do relative to a particular stock market index, whether that's the TSX Composite, the MSCI Global Index. They're benchmarked about their relative performance. And in the case of Canada, that's pretty problematic because you'd be hard-pressed to find an oilier index than the TSX. And not only is it a very oily index, but it's probably one of the worst performing of oil stocks because so much of its energy index is the oil sands, which next to coal have performed the worst of all fossil fuels in the last 4 to 5 years. And let me just give you, some practical things to consider. The energy index is oil and gas and the pipeline companies, is 20% of the TSX. To put that in context, in the S&P 500, the energy index is 5%. So it's pretty difficult if you're an institution whose mandate is to manage your client's portfolio and approximate the returns of a certain index when your portfolio doesn't hold 20% of that index. That becomes very challenging. Less so on the global case, but certainly very dominant in the Canadian case. It's a double jeopardy because not only is the energy sector so big in Canada, but it's one of the worst performing energy sectors in the world. Now, just to give you an idea, oil sands stocks, BlackRock's, who probably many of you are aware, they're a provider of exchange traded funds, they had a oil sands index that included all of the TSX listed oil sand producers. They wound down the fund in 2015 after it had lost 75% of its market cap. Again, only coal stocks would have seen a bigger decline over that area. The whole energy GICS, or sector as it's called, has had negative returns in 4 of the last 6 years and has lost 40% of its market cap. And even this year is off to an 11% decline. So as I say, it's a double jeopardy because you've got such a large energy weighting and you have one of the worst performing energy sectors because of its huge, huge concentration in the oil sands. Now let's talk a little bit about the individual investor. And I guess the challenge for the individual investor in today's exchange rate market is the problem of passive investment through index funds. Many people will say, Jeff, I don't own TransCanada Pipeline. I don't own Cenovus. I don't own Suncor. All I own is the TSX Composite or the TSX 60. And, many people do that today. And, there's a reason for that. But you must recognize that when you do that, you are buying Suncor, you are buying TransCanada Pipeline, you're buying Canada Natural Resources. Let me talk one more area of concern when we talk about divestment. I've talked about the problems for investors. There's also problems for banks. Canadian banks have some very, very significant exposure to the oil sands, over $100 billion. And that, is no surprise. The oil sands is, has been one of the largest drawers from capital markets. And they're also been, up until recently, one of the most key sources for new issue business. I worked in the investment banking industry for 20 years. Let me just point out the tie between loans and new issue business. If you're an oil sand producer, I don't know, just make up example, Canadian Natural Resources, you want to do a new share issue, you don't go into the Royal Bank and say you're going to be my lead underwriter, but I want a loan as well. Royal doesn't say, hey, go see TD down the street. I mean, the loan book is certainly something that is often tied to new issue business, and there has been a lot of underwriting of oil sands stocks in the last 4 to 5 years, which probably goes a long way in explaining why there is over $100 billion loan exposure. Governor Carney of the Bank of England, who used to be the governor of the Bank of Canada, has instructed British banks to do due diligence in terms of their lending to fossil fuel companies for reasons of how vulnerable they are to decarbonization. That certainly would be something well worth pursuing in the Canadian sector. In fact, the Superintendent of Financial Institutions has already raised concerns whether there are significant enough loan loss provisions given the credit downgrades of most oil sand producers and the rising impairment on energy loans. I'd like to close up my remarks and talk a little bit about policy, since CIGI is a policy-oriented group, with regards to 2 things: institutional funds, retail investors. Obviously every pension fund is going to have to make its own decision about divestment, but there's certainly a role for government leadership in this area. Just as the California state legislature has directed CalPERS and CalSTRS, which is the state teachers union, to divest from coal and oil sands stocks, just as the Norwegian parliament has directed Norway's sovereign wealth fund to divest from coal and oil sands stocks. Perhaps Ontario and Quebec could take a page from their climate change partner, California, who they have an integrated cap and trade system, and do likewise. Perhaps the Ontario government could provide a directive for divestment for the province's superannuation funds. Perhaps the Caisse de dépôt in Quebec could do likewise in that province. And perhaps even the Canada Pension Investment Board, the largest, of course, pool of capital in the country, might also consider that initiative. Secondly, what about you, the retail investor? Well, I think the problem for you, the retail investor, is that the capital markets aren't providing you with the products that you need. What you need is to be able to buy the market without necessarily buying its fossil fuels. Wouldn't it be nice if BlackRock's or BMO or Horizon or any of these major exchange trade purveyors of exchange trade funds for the Canadian capital markets provided a TSX without the energy sector? Provided a TSX 60 that doesn't include fossil fuel reserves. Not only would that allow you to divest from the sector, but it would allow you to make index investments that would get superior returns compared to the TSX benchmark with its full energy complement. Well, some things to consider. I think at this point I'll open it up for our next guest. Thank you very much. Thank you.
Thanks very much, Chef. Well, thank you very much, Chef. For years, a Canadian economist that countered the logic behind the oil sands has more or less been marginalized out in the wilderness. So that's not easy. And as a professor of environment and business who routinely sees undergraduate students who are raising the same questions that you are, I really do appreciate you coming here today and speaking to us about that. So that's not something that's easy.
My pleasure.
So you spoke, I contribute to a pension. Many people here contribute to pensions as well. And many of the challenges that you raised here are quite stark and quite scary. So if we actually fail to get out of some of these investments that you were talking about, get out of the oil sands, get out of our overexposure in the Canadian pension industry, really, what is the worst case scenario?
Well, you know, I think many of us think that this is a long run problem, that, you know, this is something that the world's going to have to address in 20 to 30 years, and that the financial consequences will occur within the same time frame. You know, it's happening now. How do you think Ontario Teachers has done on their investments in the TSX oil and gas sector over the last, 3 to 4 years? Millions of dollars have been lost. Ditto for the case, ditto for all pension plans. And, if you want to wonder why the TSX has been one of the worst performing markets and has trailed so badly behind the US, the energy sector is a good place to look. So what I'm suggesting is it's happening now. It's not happening 20 to 30 years. And it's been my experience in financial markets to come to the belief that once financial markets see where we're going, they're going to discount this in an awful hurry. That the adjustments happen far more rapidly than people anticipate. That the hollowing out of pension value isn't something that's going to happen 15 to 20 years from now. It's going to happen in the next 4 to 5 years. As I'm saying, it's already happened. And like who would have thought, if you were an investor in Peabody Energy, that was the largest coal company before it went bankrupt 5 years ago, that the goalposts could move so dramatically, even in, forget about the US, even in a country like China, that all of a sudden you were bankrupted. You know, the knock against Stanford University's bold move to invest out of coal stocks is, why wasn't it done before as opposed to after they had already dropped about 90% in value? So anyway, getting to your question, I mean, I think we're taking it on the, you know, we're feeling that right now. There are certainly other shoes to drop, but I think this is going to happen a lot sooner than we've been accustomed to thinking about.
One of the scariest parts of your research is this idea around systemic risk, particularly the exposure in the banking sector. My question is whether you can just elaborate on how that could happen. And the reason I raise it is that when I go speak to the banks about divestment and their exposure, or even our insurance companies, for instance, about this, there doesn't seem to be too much of a concern. And the banking sector, the one argument I always hear is like, well, these are primarily short-term loans. You know, we can get out if we have to. So I just wanted to get a little more clarification on how this could be a systemic risk for Canada.
Well, subprime mortgages were also short-term loans, and were a little more difficult to get out of. You know, systemic, and we're not just talking Canada, and it's not just Canadian banks that are exposed. You know, the whole notion of a carbon bubble, you know, we've got bank exposure all around the world, and just as subprime mortgages were contagious, you know, so would this. I think, you know, the Canadian banks maybe are somewhat more exposed than others, but this is not uniquely a Canadian problem, and it just won't be oil sand reserves that will be stranded. There'll be all kinds of financial assets in the fossil fuel industry that will be stranded or will lose most of its value. So, you know, I think there is systemic risk. Now, banks will tell you, and I was, you know, managing director of an investment bank for 20 years, you know, that banks do due diligence around loans. But typically, the benchmarks used to do that due diligence will be to look at past cyclical movements in that industry. The problem is, you know, this isn't business as usual. We can't linearly extrapolate past cycles in the future if we're now in a world where we've got to decarbonize. And hence, the parameters in which we would stress test these loans may be very different than the parameters that we've used in the past. And I think a prudent benchmark would be to say, well, if we are going to meet the COP21 commitments on global emissions, then, you know, we have a pretty good idea of, you know, between X and Y, how much contraction we're going to see in world oil demand, and then stress test those loans to the prices that are likely to attenuate that. So, you know, I'm not saying that banks don't stress test the loans, but they stress test the loans to past benchmarks, which are not likely to be relevant in this decarbonizing world that, you know, over 180 countries have committed to.
One of the other policy movements that's emerged to try and manage the financial exposure to carbon is this idea around disclosure. So the Financial Stability Board has its task force on climate change risk disclosure, and it's come out with a whole set of guidelines saying, more or less, if we give investors the right information, we can trust them to make the right decision. Could you give me your thoughts on the idea that the potential for disclosure?
Well, I mean, sure, I'd like to see disclosure. I'd like to see specific disclosure on the loan book. Typically, that's not broken down in terms of reserves being held against specific loans or against sectors. You know, I could understand why financial institutions might be reluctant to disclose that, but I would say this: if you're reluctant to disclose it, maybe you should also be reluctant about having a loan portfolio that way. The two might go together, you know. You know, these things are changing. Now, I will say one thing about, you know, the energy sector in Canada. It's shrinking, okay? And as the energy sector shrinks in Canada, it over time will be less of the loan book, just as it's less of the TSX. But right now, this is a country and a financial market that is overweight precisely the assets that are likely to lose their value from global efforts to mitigate climate change.
So what I find really interesting about the paper you wrote and the talk is that really you're describing a case for divestment around the economic fundamentals. On the climate change side, I think it's a little more complicated. And what I want to ask is divestment effective given that really most of the world's fossil fuels are actually locked up and owned by state-run oil companies?
Well, that might soon be changing. I don't know if you heard the news, but Saudi Aramco, the crown jewel of Saudi Arabia and the country with the largest reserves, is gonna go public. I would tell you right now, and I'm not advocating that you do, but if you were gonna invest in an oil company, I'd rather invest in the lowest cost producer than the highest cost producer, particularly if I thought that this is going to be a bear market for oil. I'll point out that, whether you are a state-run company or whether you are a public company, your ability to invest in new reserves is equally impaired by oil prices. Okay, if you're a state-run company, then presumably, like Saudi Aramco would use its retained earnings to develop new reserves. Well, but at today's oil prices, Saudi Aramco does make money, but many of these state oil companies, particularly in Venezuela, don't make money, so they're not going to have the retained earnings to develop their reserves. So whether it's public ownership of the reserves, whether it's state ownership of the reserves, the fact is that both have to confront the same economics, and the key economic impediment is the price of oil. And at today's price, it doesn't make sense to develop new reserves. If you listen to the bigger picture of how much we got to decarbonize, doesn't make any sense at all, because why would you develop reserves that you can never use? And this isn't unique to oil. When coal plunged got to its bottom of like $50 a ton in early 2015, Moody's said that half of the coal reserves, are no longer economically viable. Exxon had to write down recently $16 billion of oil sand assets, its entire Kearl Lake mine. Now, if you're going, well, why are they still going ahead with it? Well, because when you spent $15 billion, you just can't walk away. But the fact of the matter is that they can no longer call them proven reserves that can be added on their balance sheet, because you may think of a proven reserve as a geological concept, but it's just as much an economic concept. According to the Securities Exchange Commission, to be a proven reserve, it has to be commercially exploitable within the next 5 years at today's technology and today's prices. And that's not the case for the Kearl Lake mine. That's not the case for Suncor's Fort Hills mine or any of the new oil sand projects. So, I think what we're going to find is it's becoming very, very difficult for companies to justify reserve development, and even more ludicrous to allocate huge CapEx budgets to find new reserves.
Thank you. So I'm going to ask one more question, but while Jeff's answering, I'd invite everyone to, if you have a question, please come down to one of the two mics. If you want to ask a question through Twitter, please use the hashtag CIGI Live. And webcast viewers can ask questions online or questions at cgionline.org. Okay, we've already got a couple of people, so I'm actually going to go right to our first question here.
Okay, welcome, Jeff. I've got two brief questions. One a deep one, and another having to do with oil tar processes, such as you specified to some extent. Okay, so the first one is this. It seems that civilization in the world has its core purpose as the maximization of wealth and power without limit. And really, this seems to be the major cause of the world crises in economics, society, and environment, at least. Do you have any thoughts about higher purposes than the maximization of wealth and power? That wealth and power could serve and could act, among other things, as a check and balance on wealth and power. For example, I hear the idea going around of us being co-creators at all levels of existence according to our ability and so on. Maybe you haven't heard that one yet, but the idea of us being co-creators is the idea of evolving consciousness so we can be better co-creators, things along those lines. So that's out in the ether, okay? So briefly, the second one. I think, chemical and petroleum engineers know nothing about microbiological engineering. It is possible to engineer microbes so that they, in place, would be mined, brought to an enclosed facility, and processed by these microbes. It would be much more complex than that, but that's sort of the essence of it. And the output might be a clean carbon into the new types of, could be used as feedstock for the new carbon products that are being created, new carbon materials. Could be hydrogen, could be oxygen, could be some of the many metals that are there that could have a use. These microbes, maybe in a second set of perhaps slightly different microbes, could detoxify the toxic materials that are there, not the metals. So this is possible to do things along these lines, but I think the big thing that's holding things up is the very fact that I mentioned at the beginning that chemical and toxic petroleum engineers know nothing about microbiology. In fact, most engineers don't, and the biological sciences generally have such great potential for new types of innovations that are more in harmony with the environment.
Okay, I think I think there's going to be scope for all kinds of new revolutionary technologies. Let me just say, a couple of days ago, I was having dinner with David Suzuki. We've toured together on one of my books, and he was telling me that it won't be that long before agriculture replaces hydrocarbons as the key source of CO2 emissions. And that's, 7 billion cheeseburgers to go, and what that implies about methane emissions and the size of livestock cattle, and that, how that's going to be a technological challenge. I mentioned I was at a recent event where CIGI sponsored 3 high school students' essays on climate change, and one of the essay winners was talking about in vitro meat, growing meat in a test tube, and circumventing, of course, all the greenhouse gas emissions that would be associated with raising, livestock. And it's funny whether you consider that utopian or dystopian. Suzuki considered it dystopian, and I guess taking genetically modified food to an ultimate stage. But it gets to your point where, we're going to have to find new ways of doing things, whether it's food production, which may become the largest source of greenhouse gas emissions in the future, or in terms of energy and all kinds of biomolecular sources of new energy. And what's going to change is, before then there was no need because we thought that we had cheap and abundant fossil fuel energy. And I think as time goes by, we are recognizing that there's a great need. So, certainly technological change and the scope for, unprecedented technological change in the energy sector is going to have to be part of the solution. And, we'll see how that unfolds.
Thank you very much.
Okay, gentleman over here on my right.
Hi, not unrelated to what was just said. The elephant in the room for me, and there are probably many hundreds of elephants in this room, sorry, nothing personal. But basically, it was explicated most succinctly by the elder George Bush when in Brazil at the first COP, I believe, said the American lifestyle is not up for discussion. In other words, it wasn't going to change. The kinds of changes we need, I think, with 7+ billion people on the planet, is to somehow, as the gentleman before me suggested, curtail our expectations of the good life and see ourselves as all being in the same boiling pot that that frog found himself in or herself in many, many examples. I didn't hear much in what you had to say about the transition from a carbon economy to, say, a non-carbon economy based on solar, whatever, wind, whatever. I'm with a group called 350, pardon me, 320 is another thing, 350.org, and I'm also a retired teacher, and we've been ragging on the pension plan about this for a number of years. I think they understand, they just can't say they understand, because they would be giving things away and that would affect their investments. My concern is, how does this new environment where the climate risk is revealed going to help us create the jobs that people need to live a decent life, whatever that means? And how are we going to convince our traitorous leaders from promising the world and throwing it all away? Trudeau has offered $3 billion over 5 years. They give that much in subsidies to the oil industry every year. So I think it's a huge job. I think it's a PR job in the best possible sense. But I think people who scorn the vegans and scorn many of the others, I'm not a vegan, you can tell, but basically they need to be listened to as well. But I don't know, I didn't hear from you what you see as that. I say, take that divested money, invest it in something as far from fossil fuel, invest it in electrical cars, railways, whatever.
Okay, I think there's a number of points you raised. One is, what do you do with the money that otherwise you had in oil, gas, coal stocks? Obviously, one alternative would be to invest it in alternative energy, whether that's wind, whether that's solar. And that's, certainly a lot of people have, although not everyone has necessarily reallocated. Some have just decided we're not going to invest in fossil fuels. We talk about wind and solar and alternatives. One thing we don't talk about, and it's probably going to play a big role, and from an environmental standpoint, it's hands down the optimal strategy compared to any clean energy alternative. And that's just, what about using less energy? Okay, and we have, that solves a whole lot of problems, And, there's biases against it. You mentioned George Bush. I mean, not just George Bush, but, we've tended to equate energy or our energy consumption with our well-being. And the more energy we consume, obviously, the better off we are. Now, I think we're recognizing that there's externalities, negative externalities from that's becoming ever more, challenging. But, there's a lot to be said. And let me give you a little example. After my first book, I made a speech in Denmark. And Denmark, as you know, is, an example of green energy. And I was speaking at this energy conference, and I was astounded by the fact that 80% of Denmark's energy is coal-fired. I say astounded because what they're selling is wind turbines, and indeed, when you fly in, you see, the city ringed by these wind turbines, and they have a lot of wind turbines, and it produces 20% of the power. But coal is 80% of the power. I mean, well, hell, that's Wyoming, Montana, Alberta. Why have their emissions fallen? And, they've dialed back emissions to forget it, back to 1990 levels, which was the original Kyoto benchmark. And then I discovered a little side thing they don't talk about, because of course they want to sell you their wind turbine. What they don't tell you is that whether your power comes from coal or it comes from wind, you pay 30 cents a kilowatt, okay? That's about 3 times as much as you pay in Ontario. And as you know, we're not exactly a cheap power place anymore. So what you discover is that when you charge 30 cents per kilowatt hour, lo and behold, people turn off the lights. Lo and behold, people don't use as much energy. And on average, your average household in Copenhagen uses about 25% less energy than they do in North America. And that's not like a wasteland. You don't see lineups in front of the Canadian and U.S. Embassy. People want to migrate to, cheap coal-fired powered places like Montana and Alberta. So, I'm just saying that, maybe not everybody's suited for wind power. But I'll tell you what, if you charge 30 cents per kilowatt hour anywhere in the world, you're going to get the same result. And that's reduced energy consumption. So I think there's a lesson there. And, certainly, whatever role renewables have to play, and they obviously will have to play a much larger role, I wouldn't be surprised if an even larger role in this deglobalization is we simply dial back our energy use. And we may discover, to our great surprise, that we're no less well-being for it. So, that's something I think we're going to consider. That's something that, whether it's part of the government's environmental plan or just energy mismanagement, we're going to face in this province, because electricity prices are going to continue to rise very rapidly, particularly if we go ahead with the refurbishing of the nuclear power plant. And as we will see prices eventually get up to the levels that I talked about in Copenhagen. And I would expect we will have the exact same result on the demand for energy, which maybe isn't such a bad thing.
Thank you. My name's Steve Singer. I live in Waterloo. I like your speech, except, so how are you saying, Gween, when you wrote the world is going to be a lot smaller, or going to get a lot smaller, which I read, it was a great book, back in 2009, oil prices were $120 a barrel, and your prediction was they're going to go to 200, and thus the thesis for the book. So now, 7 years later, oil prices are $40 a barrel, $45, $50 a barrel. And so how certain are you that in the next 7 years, prices, for whatever reason, go back up to $100, $120 a barrel? And therefore, your thesis, which is fairly easy to push today, at $50 a barrel, yes, the energy sector's, nobody's done well if you look at the last 5-6 years versus the non-energy sector. It would be a more difficult sell from an economic point of view if things turn around from when your book was written then and to what may.
Absolutely.
Right? So this is the thing. Like I manage a fairly significant portfolio myself. I only buy stocks. I've done it for 15 years. I don't have to divest because my rule was I never bought a mining, an oil, a pipeline. But I'd like you to speak to the fact, you mentioned 20% of the TSC is oil related. Mm-hmm. And my portfolio is almost exclusively TSC, and 80% of it is not. And could you speak to you were an investment manager. I mean, there's so many companies out there like TELUS and Alimentation, Jean Couche-Tard and Richelieu Hardware, and the renewable energy portfolio like Northland Power and Brookfield Renewable. There's so many in that 80% that if we could realize that, then when oil prices do go back to $100 a barrel, maybe they will, technology related or some other reason, there's still that positive incentive, not mandated by governments, but easy to do as an individual. In my returns, especially the last 5 years, because of my rules that I developed a long time, and even before, are equally as good investing in that 80% in the TSC that's not energy. So to me, I'd like your comments on that.
Okay.
Because there is, I think there is a lot of
Right,
places
okay.
you can invest in the market or not, solar share and so on. But anyway.
Well, that was one of the reasons I'm saying that it would be good if we could buy a product that would give you the 80%. Now, you can build the 80% up through individual stock selections, but most people these days don't do that. Most people buy an exchange traded fund.
But why is that?
Well, I think,
See, I have this argument with my millennial son, and he's on his phone all the time. And I said,
Yeah.
Alex, if you would spend less time on your phone and maybe an hour a week looking at your portfolio, you could do this. It's not hard.
I agree.
So why do they do that?
Well, what I'm trying to suggest is that maybe we should have more financial products that allow the investing public to buy the 80% without the 20%, okay? And I think ultimately we're going to get there, and that's going to allow people to not consciously invest in oil sand stocks or whatever fossil fuel stocks. I don't want this to become a portfolio clinic or something, but you mentioned you had 80%, you had your portfolio in the other 80%. I mean, that's good. I think any investor would want to have exposure to broader indices, particularly given the underperformance of the TSX. You probably want to own something like the MSCI Global Index, and that would have some energy stocks, but at a very small weighting. You mentioned earlier my first book, which I wrote in 2009, talked about the notion of how triple-digit oil prices could be deglobalizing, since the sense of distance costs money. So, the only way that we move goods around the world is burning oil. At $10 a barrel, transport costs are incidental. At $100 a barrel, they're not. I should point out, and you say, well, now that oil's $40 to $50, what relevance does that have? I should point out that what holds for oil holds for carbon emissions. That if we were to, for example, put $100 a ton on carbon emissions, it would have the same deglobalizing effect as $100 oil prices. I think that that's still valid. What about, oil prices getting back up to those levels? Prices are everything. The oil sands are not a new discovery. They were known for decades. They were ignored because they weren't considered commercially viable, because in a world of $30 to $40 oil sands don't make sense. When oil got to $100 a barrel, all of a sudden this ignored resource was, in the eyes of the International Energy Agency, the world's third largest reserve. So, prices mean everything. You can have whatever oil price forecast you want, but I think what's different today than the past was that, in the past, we could always rely on business as usual growth in world oil demand. And, not only the $200 call, but many years earlier, I was the first economist, at least in this country, to predict $100 oil prices. That was because of the depletion of conventional supply. And that didn't change, by the way. Conventional supply peaked in 2007, and hence the reliance on ever more costly non-conventional supply. But that was still in a world where we thought that global oil demand was going to grow every year. And it notwithstanding the cycle, it pretty well has done that since World War II. The kind of world that we're talking about now is conclusively where there's no room for that to happen. We can debate whether, it's a 25% or a 50% reduction in world oil demand, but I don't think there's any debate that, carbon mitigation strategies are going to significantly impinge on fossil fuel consumption in the next 20 to 30 years. And in that world, the high-cost producer, quite apart from their whether they're clean or not clean relative to other sources of fossil fuel, the high-cost producer gets squeezed. And that, I think, is basically what we're looking at with the oil sands.
Thank you.
My name is Brian Finlayson. I'm from Kitchener. I've heard you and a number of other presenters here over the course of the last few years consistently speak about fossil fuel scarcity and so forth. And I understand the political agendas that flow from that, but I would like to know from you, what is the evidence that in fact oil, black coal, gas, and so forth are in fact fossil fuels and scarce?
I'm not saying they're scarce, because scarcity, and this gets back to the comment of reserves, isn't just a geological concept. It's an economic concept. Like, how much oil we have to burn isn't just about how much oil exists under the ground, but what the price of oil is. Because obviously, the higher the price of oil, the more reserves that we can burn. The lower the price of oil, the less reserves we can burn. And the same is true of coal and natural gas. And, you know, I think what we're seeing is that as prices fall, resources that we thought were economically viable all of a sudden don't become viable. And that's basically, you know, what we're talking about. And the evidence of that is, I mean, just look at the massive exodus of multinational oil sand players from the industry. And I would argue that they're not fleeing because of the future world that we're talking about today. They're fleeing because even in today's world, production doesn't make sense at those oil prices. So, you know, to complete the circle, we're going to go full circle from the 1970s. You know, we've spent the last 50 years trying to lessen our energy dependence on the Middle East by developing our own sources of energy supply, which we have, shale and the oil sands. The only problem is that those fuel sources only flow with high prices. So, you know, we're going to end up with OPEC dominating the market even tomorrow, more so than they did in the 1970s. But instead of a fuel that the whole world economy is predicated upon, it's going to be a fuel that's going to become less and less important. And that's why I think, you know, Saudi Aramco is being made public. It's maybe this is the last twilights of being able to capture the huge economic rents from fossil fuel reserves while the world's still burning it.
My question had to do with the evidence for it being fossil fuel. I understand market forces, political interests, and so forth affecting viability of development of resources, but my question was, what is the evidence that gas, oil, and black coal are in fact fossil fuels?
Sorry, I'm not quite sure that I understand the question.
Well, you're saying, you're implying, I believe, that the source of the oil and so forth that we've been talking about is fossil in origin. And I'm asking you, what is the evidence for that?
Okay, I think I'm just referring to a group of hydrocarbons as commonly referred to as fossil fuels. And I would be talking here about coal, nat gas, and oil, which right now are the #1 source of greenhouse gas emissions. They're called fossil fuels. You're suggesting that perhaps that's a misnomer, and perhaps it is. But anyway, that's the context in which I'm discussing them.
Gentleman here on the left.
With all the questions that have been going on, I'm trying to figure out what to ask you now. I find that the majority of people I talk to, and online especially, will always say, well, oil is what makes the world go round. And my biggest argument with them is that, yes, right now it makes the world go round, but it's also ruining our world. And there's also, when we talk about economics, there's a lot more viable options, especially with the price of solar has dramatically dropped. I personally have two 10 kilowatt microfit arrays. I drove here tonight in an electric car. And I'm not trying to tout this. I'm trying to say that economically, people said, well, isn't that expensive? And I'm like, no. I drive a Chevy Volt. Last year, I drove 24,000 kilometers, spent $480 in gas, only because I had to go to like long distances, but 90% of the time, I'm driving within town. I guess my question is, in terms of reducing the energy use, which I think is a great idea, the complexity of people, and even in corporations, for example, 401, all the people driving to Toronto drives me absolutely crazy because I used to get there 50 minutes from downtown Kitchener, and I don't see carpooling. I don't understand, with all the technology we have, why so many people are in offices downtown Toronto from Kitchener and everything, that respect. What can we do to change the mindset of people to help them realize? Another perfect example is that with the oil sands, as you say, those workers are eventually going to be not having a job, but there's 5 times the jobs in renewable energy. Again, how do we change this mindset in people, and what do you feel is the best answer?
Well, I'm an economist, so obviously I focus on prices. If we're talking about oil's last stand, because don't forget, oil isn't used in the same way that it was before. Like when I was a kid, my parents' furnace was an oil furnace, but after the OPEC oil shocks, everybody switched to nat gas. And, you know, in some places we used to burn bunker fuel to generate power. And outside of the Middle East, no one does that anymore. So what's oil's last stand? Oil's last stand is on the road, right? I mean, it's transport fuel. And really, if we're going to significantly reduce our oil consumption, you know, along the lines that we've been talking about today, it's going to be through the electrification of transport or from people just driving less. And here there's a challenge. And the challenge is that, yes, you're driving a Volt, and yes, Tesla's got a lot of orders. But if I was here from GM or Ford or Chrysler right now, I'll tell you what's really hot. Pickup trucks and SUVs. And let me tell you why they're hot, because of pump prices. And here's the challenge, you know, if the world decarbonizes, oil prices fall. Oil prices fall, fuel prices fall. What happens when pump prices fall? People start either driving more or driving, you know, SUVs. And that's a challenge. Carbon taxes certainly could play a role there. You know, could play a lot bigger role than, say, in utilities. If you close a coal plant, it's not like you can build your own coal plant in the backyard if you want to have coal-fired power, but you can buy your own SUV. So that's really going to be the challenge. Transport, I think that's already happening, that people are, you know, working at home more, commuting less, but the cost of travel is part of that. And not just the fuel price, but, you know, like driving in here from Toronto on the 401, where it's just tractor trailer after tractor trailer, is, you know, has a cost. And, you know, people don't want to do that either. But I guess, you know, the real challenge here is going to be, since, at least in this part of the world, we consume oil as a motor fuel, you know, if oil prices keep falling and it gets passed on to pump prices, it's going to give the wrong signal for where we have to go. And, you know, I mean, there's a variety of policy measures. Carbon taxes could be one, but that's really going to be the critical battleground, because, you know, over 60-70% of the oil that we consume in North America is consumed as a transit fuel.
Okay, there's a gentleman over here that's been waiting for quite a while. I'm going to take this question and your question as well, make those the last two questions, and hopefully have a good memory to handle them both, I'm sure.
Okay.
A major theme in your argument seems to be that the major impetus for divesting from fossil fuels is that worldwide fossil fuel demand is going to drop. There's efforts going on throughout the world to lower carbon emissions, and as a result, that's going to reduce demand. But we saw with Harper and we're seeing now with Trump how easy it is for politicians to just renege on those agreements. Those agreements are worth the paper they're written on, and they can be turned around just as easily with a new political cycle as they could be entered into. And fundamentally, it's easy to promise things. It's much harder to deliver on them, especially when you're answerable to your voters. But even in an autocratic country, you're fundamentally answerable to the happiness of your citizens. There's 1 billion people in India who I'm sure would like to consume on the level that we consume, and that's where we're headed. So fundamentally, isn't it much more likely that worldwide demand is going to increase as more people enter the middle class than it is that politicians are going to keep their word about agreeing to reduce emissions?
Let me rephrase that question. You know, what's the outlook for U.S. coal now that Donald Trump's in power? Would be a variation of the question that you're asking. And I guess the answer to that depends on how important do you think Obama was? If you think that Obama's clean air plan is the reason that U.S. coal has gone from 50% to 32% of power generation.
Fracking was the reason.
Well, yeah, then you know what? Then you're right. You know, he's going to rescind that. But what happens if Obama wasn't driving the bus? What happens if he was just jumping on the shale gas bandwagon? Because here's what shale gas has done. It's allowed you to close coal plants without raising people's utility bill. And believe me, that's a very significant factor, okay? That the only reason that Obama could mandate the closure of coal plants was he knew that you can today generate power burning shale gas. Now, we can debate how much cleaner shale gas is than coal, but that's a separate argument. So if the question is really technological, and if in fact Obama was just being an opportunist here, then Trump coming into power doesn't change a damn thing. Because as long as you can generate a kilowatt of power cheaper by burning shale gas than coal, that's exactly what you're going to do, clean power versus plan versus no clean power plan. So, you know, we've seen the goalposts move, not just in the U.S., which is the second largest coal burning country in the world, but way more important, in China, which single-handedly burned over half of the world's coal supply. We've seen the goalposts move, and we know the goalposts have moved because you just look at what's happened to China's coal consumption. It's plateaued and it's now starting to decline. So I think there is sort of irreversible momentum here, notwithstanding, you know, Harper, notwithstanding Trump. You know, my personal read here is that, you know, the goalposts are moving and they'll carry the politicians with them. And insofar as Trump is concerned, I think that people who, you know, are sort of despairing over Trump's, you know, appointments at the EPA and everything are giving far too much credit to the past Obama administration for the strides made against coal, and far too little credit to George Mitchell. I mean, George Mitchell was saving the world from carbon emissions was, believe me, the last thing on his mind, but he married the practice of horizontal drilling with hydraulic fracking, and as a result, single-handedly buried virtually every coal company in the United States. He was a wildcatter who, and believe me, climate change wasn't his thing, but nevertheless, hydraulic fracturing has done more to bury coal than Obama's clean air plan.
Thanks.
Okay, thank you. The Canadian dollar is often referred to as a petrodollar. I'm wondering if you think there's a lower bound for the Canadian dollar. I see a fairly high correlation between the price of oil and the price of the Canadian dollar. In the long run, are we looking at a 40-cent dollar or a possible North American currency?
Well, certainly the Canadian dollar went to places it should not have gone, and this part of the country played a terrible cost in terms of the loss of manufacturing jobs, everything from auto parts to food processing plants, because we went for a period of time to a premium exchange rate. I think historically, if you look at what kind of exchange rates make sense, it's probably about 75 to 80 cents on a unit labor cost side. So it has created distortions. Whether we'll continue to be a petro currency, in all things, there's self-adjusting factors. We became a petro currency because our capital flows were dominated by massive investment in the oil sands, and oil temporarily replaced autos and parts as our leading export category. Both of those are reversing. As the oil sands declines, as oil production wanes, as oil prices fall, as investment in the sector tumbles, then the association of Canada with the oil sector is going to become weaker and weaker, and other factors will play, so that I don't think that further decline in oil prices would necessarily always drag the Canadian dollar down. But to the extent that the Canadian dollar today is still affected by oil prices, and it is, not to the same extent that it would have been 4 to 5 years ago, that's going to be a negative for the Canadian dollar. A lower Canadian dollar is not necessarily a negative for us, particularly in this part of the country. And as I said, the cost of the petrodollar, was born largely in Quebec and Ontario, that lost a good chunk of its manufacturing sector. But, the good news is, just as, the sector shrinks, its weighting in the TSX shrinks, it becomes less problematic for pension funds to divest. Here, the same will be the case, that the link between oil prices and the dollar will weaken, and it will become, falling oil prices will become less of a drag on the currency than it has been up until now.
Well, thank you very much, Jeff.
Oh, my pleasure. And I'll hang around here for anybody who wants to ask me further questions.
Waterloo crowds are very polite, but always tough. So thanks for answering our questions.
My pleasure.
So as we approach the end of tonight's lecture, I want to thank you, Jeff, for highlighting the implications from divesting from fossil fuels with your usual impeccable clarity, and Jason for helping with questions. Before we adjourn, let me thank once again Divest Waterloo, with whom we have co-organized this event, and also let me remind you that outside the auditorium in the foyer there is a reception, and you are all invited to join us and the speaker as soon as we adjourn. So thank you so much, and again, Jeff, thanks very much for your refreshing lecture and thoughts.